Most people are staring at Bitcoin right now and thinking it's just another pullback. They're wrong. There's a trap being set, one that will wreck late shorts and fool early dip buyers in the same hour. And it all starts with a number the herd is ignoring. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. Bitcoin is at 63,771. The monthly trend is a strong sell. The weekly trend is a strong sell. The daily trend is a strong sell. Even the 5-hour chart screams strong sell, but the 1 hour is neutral, and that 1 hour pause is the fuse. This is a breakdown session with a trapdoor built in. I'm calling it live. The immediate bias is bearish continuation within a bear flag structure, but we are coiled right above the move that triggers the final flush. The single invalidation level that flips the entire bias back to range-bound and potentially puts 68,000 back on the table is a daily close above 66,820. Write this number down. If we break and close above 66,820 today, the entire bearish structure resets, and you must abandon every short below it. But until then, the path of least resistance is down. Here's what the herd is doing, and it matters. Retail longs are still stacking in at these levels, convinced that 63,000 is the ultimate buy the dip opportunity. Meanwhile, the smart money flow is screaming the opposite. Bitcoin ETF outflows have accelerated for multiple days. This tells you institutional risk appetite is cracking. They are not buying the dip, they are distributing. And the funding rate, which I track tick for tick, is flipping negative in certain pockets but not yet at washed out extremes. That means we haven't seen the true liquidation cascade yet. When you combine bearish institutional flow with trapped late longs, you get a powder keg. The bear flag completion near 63,000 is the matched. Let's go to the charts and build the narrative from the top down. Starting on the weekly, Bitcoin is in a strong sell structure, comfortably below every major moving average. The 200-week moving average is way up at 80,936. It's a distant ceiling, not support. The daily picture is even more brutal. Price is below the 5-day moving average at 67,262, below the 10 at 70,093, and below the 20 at 72,977. The 50-day at 74,592 and the 100-day at 75,866 are both sloping down, forming a death cross dynamic that's been grinding for weeks. This is not a bull market pullback. This is a trend transition into a bear phase. Right now, we are trading at 63,771, which is under the critical daily support that was previously 64,161. That level has been violated intraday, and if you've been following this channel, you know that old support becomes new resistance. The next major support zone is 63,155, and then the real danger zone at 61,505. The measured move target of the bear flag. The bear flag on the 4-hour chart is textbook. We had a sharp impulse down, then a tight upward sloping channel of low volume consolidation, and now the flag's lower boundary is cracking. The flagpole measures roughly 6,000 points from 68,000 down to 62,000 on the initial impulse. The measured move from the breakdown point near 64,161 gives us a target right at 61,505. That's not a coincidence. That's the market targeting the next liquidity pool. On the 60-minute chart, the moving averages are stacked bearish, but price is hugging the lower band, showing compression. The 20-period MA on the 60-minute is at 64,080, acting as dynamic resistance. The MACD on the 4-hour is deeply negative at -2,874 and still expanding, with no bullish crossover in sight. However, here's what most traders miss. The daily RSI is at 18.2, extremely oversold. That's not a buy signal on its own, but it creates a setup where any short-term bounce will be violent and will trap fresh shorts who chase the breakdown too late. The stochastic reading of 87.2 on what appears to be a lower timeframe is suggesting that within this bear flag, there's been a stealth oversold bounce already, and that bounce is losing steam. When you see a high stochastic inside a strong downtrend, it's a bearish continuation signal. The bounce has done its job of resetting oversold conditions and will likely roll over. This is exactly the mechanics of a bear flag. The bull-bear indicator at -15,925 confirms massive underlying bearish momentum. So the technical deep dive verdict, we are bearish, the flag is completing, and the 63,155 support is the trap, break that, and it's a liquidation freefall towards 61,505. But if that level holds and we see a swift rejection with volume, the counter-trend squeeze could punish over-leveraged shorts all the way back to 64,161 and even 66,820. Now, let's connect this to the fundamental driver, the money flow, not the narrative. In the last 24 hours, the core news is that Bitcoin ETF outflows are persistent and accelerating. Institutional risk appetite is cracking. I want you to think of Bitcoin right now not as digital gold, but as the risk asset shadow. It is trading almost tick for tick with Nasdaq futures, but with a higher beta. When the S&P 500 futures start to roll over and the VIX structure shifts into contango, liquidity, sensitive assets like Bitcoin and Ethereum get hit first and hit hardest. The yield environment is doing us no favors either. Real yields are steady at elevated levels, and that historically creates a headwind for non-yielding speculative assets. The macro divergence is clear. Equities are hanging on by gamma, but Bitcoin is already breaking down. That's a leading signal. For the next 1 to 2 weeks, my directional lean is bearish as long as we stay below 66,820. The exact event that invalidates this entire bearish lean is a daily close above that level, or a sudden reversal in ETF flows where we see 3 consecutive days of net positive inflows above 300 million. Until then, the pressure is down. Do you think Bitcoin breaks below 60,000 this month? Comment yes or no right now. I'm tracking consensus, and it helps you lock in your conviction. Now we are at the section most people skip, and that's exactly where the money is made. Keep watching. I'm about to give you 3 trade setups with exact triggers, stops, and risk-reward logic. These are not vague ideas. These are actionable plans that you can screenshot and set alerts on immediately. Strategy 1, the sniper, conservative. This is the highest probability play. You wait for the bear flag to fully break down and then short the retest of broken support turned resistance. The trigger condition is a 1-hour candle close below 64,161, followed by a pullback that respects that level as resistance, ideally with a bearish engulfing or wick rejection on lower volume. Your entry is a limit order at 64,161 with confirmation. Stop loss goes at 64,850, above the recent swing high and the 4-hour demand zone. The logic is simple. If buyers push back above 64,850, the breakdown is false and we are getting a squeeze. Take profit 1 is at 63,155, which gives you a risk reward of roughly 1 to 1.5. Take profit 2 is the full measured move at 61,505, stretching the R multiple to around 1 to 3.8. This setup is void if we get a daily close back above 66,820 before you're filled. The sniper, conservative, entry, 64,161, limit, after 1-hour close below and retest rejection, stop loss, 64,850 take profit 1, 63,155 take profit 2, 61,505 risk, reward, 1 minute and 1.5 seconds to TP1, 1 minute and 3.8 seconds to TP2 invalidation. Void if daily close above 66,820. Strategy 2, the active trader, standard. This one is for the momentum trader who wants to ride the waterfall as it happens. The entry condition is a clean 4-hour candle close below 63,155 with expanding volume. That's the trapdoor. Once that level snaps, stops from over-leveraged longs get run, and liquidation cascades kick in. You enter on a stop market order at 63,100, giving a small buffer below the level. Your stop loss goes at 63,550, just above the breakdown point, giving it room to breathe but keeping risk tight. The reasoning is that a reclaim of 63,155 after the breakdown would signal a liquidity grab, and you want to be out. Take profit 1 is at 61,800, just ahead of the next support cluster, and take profit 2 is at 61,505. Once TP1 is hit, Move the stop to break even and trail it by the 20-period moving average on the 5-minute chart. This setup capitalizes on the emotional flush, the active trader, momentum, entry, 63,100, stop market on 4H close below 63,155, stop loss, 63,550 take profit 1, 61,800 take profit 2, 61,505 risk, reward, 1 minute and 2.2 seconds to TP1 invalidation. Void if 1H candle reclaims 63,155 within 2 hours before I give you the aggressor play. Type your Bitcoin range for the next 24 hours in the comments, high and low. I'm building a heat map of retail expectations, and it's often a beautiful contrarian indicator. Drop it now. Strategy 3, the aggressor, high risk. This is a counter-trend long scalp designed to exploit the extreme daily RSI oversold condition and the bear trap that often forms before the real plunge. It is only for those who can lose small and manage risk aggressively. The trigger is a bullish divergence on the 15-minute RSI with price holding above 63,155 and showing a sharp rejection candle with a long lower wick. Entry at 63,200. With a hard stop loss at 62,750, below the recent sweep of the 63,000 zone. Take profit is at 64,161, the broken support now resistance. The risk reward is around 1 to 2.1. If this trade triggers, you must move stop to break even as soon as price reaches 63,700. This is not a trade for the faint-hearted. It is a high-stakes scalp that preys on the moment the market punishes momentum shorts before continuing lower. One warning: if we see a 15-minute candle close below 63,155, this setup is immediately void and you stand aside the aggressor, high-risk countertrend, entry, 63,200, limit, after 15 minutes bullish divergence and rejection above 63,155, stop loss, 62,750 take profit. 64,161 risk, reward, 1:2.1 invalidation, void if 15M candle closes below 63,155 now, a quick risk management pulse. Never risk more than 1 to 2% of your trading capital on any single trade. No new positions through high-impact news events. I'm talking FedSpeak, CPI, or any sudden exchange headline. Stops are non-negotiable. This is how you survive to trade the next big move. Let's close the loop. The single most critical level for the next session is 63,155. If that support fails on volume, the bear flag completes and the air pocket down to 60-1505 opens fast. If it holds and we see a mechanical bounce, the bearish structure still remains in control until 66,820 is recovered. Tomorrow's focus will be the Bitcoin Nasdaq correlation dance. The S&P 500 is flirting with its own gamma flip zone, and if equities catch a bid, we could see that counter-trend squeeze are mapped in the aggressor play. But the dominant flow says, sell rips until proven otherwise. If you want the full breakdown on gold, the real fear architect right now, and how it's pricing a geopolitical shock that Bitcoin hasn't yet absorbed, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, before the herd catches on.